Hey, thanks everybody for coming out tonight. I know almost all of you. We wanted to mix it up this year and do something a little different in talking about the president and policy, because I always do everything I can to avoid that. So we thought, well, we'll take a stab at it. But it's interesting times. And, so I will tell you that I'm going to present to you some things that just help set the stage for what's going on in the economic landscape. And really, it's just a different way of thinking if you look at the different policies. But I'm not trying to pick sides, because I think every side's got value and every side's got things that we wish they could change. But just to show you some things that are going on, I wanted to take a second and thank MFS, Investment Management, and Fidelity Investments, both of those two firms. We've done a lot of work with them over the years, but they helped pay for this tonight for you guys to come out and enjoy this presentation. So many thanks to them. So just so you know, in case you didn't, this is for educational purposes only. There's no investment advice being distributed here. No run out and buy this or sell that. And we do our investment security process through Cetera and all that good stuff. All right. So here's the premise. We kind of picked this monopoly theme because most of our clients, most of you, we have been around for a while. We've been around the game of life for a long time. And in a figurative sense, we've all been around this board. I know everything from free parking to collect and go to buying property to, hopefully you haven't had to go to jail, but it's on there, right? But, the way that we've all learned to make our financial decisions is inside the framework of a life and a system that we've just learned because we've been a part of it for a long time. And if you really put the pieces of what a lot of the Trump mindset is together, you begin to see a different game board. And I'm really weird because that actually is fascinating to me, and economics has been my thing for a long time. But I want to try to share some things that are going on, and that might help you in some ways just frame, your outlook for, what you're going to do for the next 20 years if these things come to pass. So here are some of the things that we are going to talk about that we know are policy perspectives that Trump has very clearly said, hey, this is the issues I want to attack head on. Excess regulation hurts the American economy. He believes that wholeheartedly. He believes that the investment money in our infrastructure is required, like it is going to happen. In his mind, it doesn't matter where the money comes from, we're going to fix roads, bridges, schools, railways, all that stuff has to be improved. He believes this concept of nationalism, which we'll talk a little bit about, will create American jobs. And I think I think he's probably right. But just the question is, what does it look like? Wage inflation. We haven't seen inflation in a long time, really. I mean, so long that I don't think most people really fear what it does. But his policies are intended to create it. And that's not necessarily a bad thing, but we're going to talk about that a little bit. And then big time increased spending in military and technology. And then he doesn't care about deficit spending. If we got to borrow the money, he doesn't care. And that's probably because he's borrowed tons of money to build many businesses, and some have been successful, right? So let's talk about this one real quick. Excess regulation. This is very interesting. This is the number of regulations passed each year that have had significant diminishing effect on corporate profits each year. And they're anywhere between 900 back in 2008 up to 1,400 per year, new ones have been passed each year in the last 7 years. And so these things cost money. We know in our industry that the cost of regulation, when we have to charge a fee to you to do what we do, about 35% of every dollar that we collect from you goes to them, the regulators, and the cost to do all the things they ask us to do so that we can wear the name tag financial advisor legitimately. So that's just in our industry, but it's in every industry, right? So that's a big issue. He thinks that that's hurting our economy. Infrastructure spending. So this is a report from the American Society of Civil Engineers saying this is the status of some of the things in our country in terms of A is safe and good and great and healthy, and D is kind of scary, and E is F, whatever would be next would be, we've got people not successfully traveling those bridges and stuff, right? So everything from solid waste plant, public recreation, the ports, bridges, rail, these are the ones that are failing. Because these are the ones that are borderline failing. Okay, here's the ones that are failing. Aviation, $22 billion a year in congestion, airport delays, inland waterways hadn't been updated since the 50s, levees, 100,000 miles of levees in the U.S. are quite fragile. Dams, there's 4,000 of them that are deficient at this point in the U.S. Drinking water, many cities have 100-year-old or more pipes. 240,000 breaks per year in the U.S. Hazardous waste, 1 in 4 Americans live within 3 miles of a waste site. Roads cost $101 billion in wasted time and fuel every year. There's congestion and potholes and orange and white barrels, right? Flashing lights. Schools, spending on schools is half the level today as it was before 2007, 2008. It's a lot of expectations from our teachers, our young people, and not producing the resources to give them what they need. Transit is a problem. Wastewater is a problem. Energy. Most of the original grids that we still use today were built in the 1880s. So we've got a lot of work to do in the infrastructure, right? So he's very concerned, and he thinks this is an opportunity. It's an opportunity to spend a lot of money and create a lot of work. And the lot of work part is something that I feel is a common denominator that President Trump wants. Is a lot of work to be done. Another thing that is seen throughout the policies is this concept of nationalism. So consider that globalism is when everybody in the world's competing to make the same mousetrap. And so we can buy it far off and bring it here for cheaper than we can make it in our own backyard, so it makes prices lower. However, if you do that enough, which after NAFTA was signed way back in the day, long-term effect of that is many jobs have gone overseas that we used to have here. Now it's interesting because the debate is, well, what if you could bring a lot of those jobs back here? What does that look like? And it's a lot of robotics and a lot less people and a lot more technology rather than work. But there's people to run those types of things. But he would like for us to have an economy that produces a lot more of what we consume than what we bring in from overseas, specifically to drive up work and bring people into the workforce, because that extra amount of work creates wage inflation, right? You get inflation low enough, and now we got another million widgets to make at this plant over here, and plant over here is at full capacity. Plant A is going to say, hey, come over here and work for us, and we'll give you a raise. So you don't stay there, and you drive this competition in wages if you have enough work to go around for everyone. And if you have more work to go around than everyone can do, then you really begin to see things accelerate in what people get paid. So nationalism is the concept of creating more and more goods here so that we don't have to get them overseas, and then that creates this wage inflation. Now, here's what's interesting. This chart, see, to me, this is interesting. Maybe to you, I don't know, okay? But to me, this is really interesting, right? Because this is our future, right? So This is showing us the amount of people that have left the workforce in our country, right? And this is labor force participation. And so in 2017, 62% of our country is interested in working, okay? Meaning 38% are disinterested. They would rather do whatever it is they're doing other than work, okay? Now, of that 38%, you've got some things going on in there. There's a certain percentage of, people with a felony record, or maybe children, or people that are elderly, or people that have health conditions or whatever. But the aging part of that is a reality. That's the boomers getting so old that they're like, hey, if you keep coming to work, we don't know what you're going to do here, right? It's because, not picking on, but we slow our roll when we get older, right? So I think that this other category has been a real problem. There's so many people that aren't just aging out. There are people that have chose to sit out. And in some cases, it might be because they can, in certain places, maybe they could get or food stamps or assisted, living, or they could get unemployment for an extended period of time, and it would be more of a nuisance for them to put that down and go to work than it would to continue to collect that. But notice in this last little bit, the direction of this is starting to kind of go up. And part of that is because there are more and more jobs that are creating this competition for labor at the bottom end in the working class that's saying, hey, you know what, if I were to go back to work now, I could get paid $450 a week, whereas like 2 years ago, I might only get $350 a week. Well, if you keep bumping that number up for the unskilled labor, eventually they're going to say, hey, I'm going to go back to work because I could actually make something. And so nationalism creates a heating up of that working class job environment. So a lot of the policies that you see are really driving that. And it's interesting is if you could get this to converge to where really the only people that aren't working are the elderly, the aging, and the children, we probably could get about another 20% of economic output out of our country. In fact, there's probably some of you that may have quasi-retired or maybe going to retire soon that you might say, if somebody paid me enough, I might go back to work some, right? I mean, it's all about motivating people to create more. That's, so that's an interesting way of looking at it. More jobs, no extra workers, wage inflation. Now, one of the things that I thought was interesting is throughout all of the campaigns, you hear what's your position on foreign policy and work and jobs and growth and debt and so on and so forth. No one really talked much about, hey, if we can make it so that anybody can get a job that's paying a lot more today than it was 2 years ago, it changes the way the economy works. Nobody really talked about that. And I don't even think, this is just my opinion, I don't think that Trump was able to articulate that perspective. But if you look carefully at each of the policy agendas and how they connect, wage inflation is clearly a targeted outcome. And that's just something we haven't seen in a while, right? So wage inflation can create a different landscape. Because what happens after you have wage inflation? What happens next? The goods and services cost more, right? So that's the next part, right? Well, okay. So what happens if I can get paid more, but the stuff costs a little bit more, but really there's this thing called the wealth effect. The wealth effect is how much do you earn on what you've already put aside, right? So we've been saving up your money in a nest egg for years and years and years, and if that is earning 0.5% at the bank and inflation is 3 or 4 or 5, it makes you think differently about, well, what am I going to do with that money versus maybe if you've invested in things that benefit when you have inflation, now that money's making 6 or 7 or 8, it changes where we're driven to put our money. You follow what I'm saying? So we haven't had inflation enough to actually warrant a lot of discussion there, but I think it's coming. I think it's coming. The numbers are starting to show some of that. So this is an interesting tidbit. Again, interesting to me, maybe to you, okay? So this shows us, in terms of growing our economy, how in the world are we going to grow our economy so our stocks can grow, so our portfolios can grow? Growth comes from two things: labor force going up, having more people, more workers, and then productivity per worker. So if a company hires a new 1,000 people, they're going to get a certain amount more output. But if they equip those 1,000 more people with 5 more brand new computers that go fast and do things they've never been able to do before, then they're going to get even more output, right? So it's productivity by workers plus your essentially your headcount productivity. So this is showing us in the different decades, if you go back in time, that our GDP in the 70s was, our regular growth, the actual headcount part, okay? We actually grew our population part of that by 1.3%. And in the 80s, we grew our population by 1%. And there's two pieces: the immigrant population and native born. So, a lot of people have come here for work, right? So we know that investment spending in the U.S. in corporate America has been very flat, in fact, slightly negative for the last 4 or 5 years. So we don't expect a lot of productivity gains because we haven't seen a lot of spending there, right? And we look forward and we say, wait a minute, next 10 years, the actual labor force growth is expected to be 0.3, and 25% of that 0.3% is immigration. Which, if we can get Mexico to build a wall and not let anybody cross it, if that were to happen, then that 0.25 is going to be an even lower number, right? I mean, I'm talking about, President Trump wanting Mexico to build a wall, protect our borders, and understand all that comes with that. But if we're at this low of growth with headcount, and we really tighten down on immigration, okay? What that's going to do is it's limiting the number of workers. If you increase the number of jobs and you intentionally limit the number of workers, what's going to happen to your paycheck? It's going to go up. Now, I'm telling you, we haven't had a politician think this way out loud in a long, ever, right? And that's one thing about President Trump. He's not scared to just tell you what he thinks. But so it's an interesting way of looking at it. It's different. We've never had an administrated where you've got the House and the Senate and the presidential seat all in alignment, for the most part, at least with the same title, and then the president saying, hey, we're going to do this, and what we're going to do is we're going to make it so we're not going to grow our population at all, and we're going to create all kinds of jobs. So it's wage inflation. It's very, very real. So if you're an employer and you now see that every year your cost of labor is going to rise because of the environment, what are you going to do? You're going to buy some technology. Say, all right, I can't keep paying Billy and Sammy and Susie raises that are at this level. Let me buy some, Apple 16.4s and some Cisco whatevers, and let's put some things in here to make everything go faster so I can get more out of Susie and Jimmy and Billy. So you'll see, and we are seeing right now, in fact, this year, earnings, some of the surprises to the upside is in the technology space, where there's more orders for technology that makes more efficient workplaces. Because it's cheaper to buy and invest in technology than it is to pay higher and higher wages. So it's an interesting perspective. This one is also very different, okay? Now, I'm going to I want to step in a trap here, okay? So I'm going to tread real lightly, right? But think about this. The cost to operate our military is an incredibly high number, and it has been forever. It's right up there with the cost to take care of our seniors in Medicare and Medicaid and disability. I mean, it's a huge expense item, and it is incredibly important to have it, right? But the challenge where people really, I think, get into political debates is, well, how do we use that military? I mean, should we be the world's police? You've probably heard people say that, right? And I think you could say absolutely, and you could say, well, I don't know, right? But Trump has said, and he says it loud and clear, hey, if we're going to provide security, we're going to expect payment. You guys heard him say that, right? I've heard him say it 3 or 4 times. Well, that is not like the monopoly game that we've ever played, right? We're going to have the largest superpower military in the world, and you can have access to it as long as you help us to pay for it. Hey, I mean, it's either brilliant or crazy. And I don't know the answer. I don't know the answer, but I can tell you right now, areas that need it will pay for it. I told you guys, I had kidney stones last week. Never had that before. That was very unpleasant, to say the least. I haven't been, that's not even wood. I haven't been to the hospital. Okay? I haven't been to the hospital in 40 some years until last week. And I didn't know they could do what they can do there. I was in so much pain. I am a pansy, okay? I had this blanket. I am shivering. I want somebody to just knock me out. I can't. The guy won't get me a room to do something with this pain. I'm on the floor. This blanket's a big brown blanket. I look like a bear hobbling all over the floor trying to just deal with this pain and not, have more pain. They take me in the hospital. They stick me, and 3 minutes later, no pain. I was like, wow, right? That was like on Tuesday. And, they said, you got a kidney stone, you drink a lot of water, here's some more medicine. Next day, it's terrible again, and it came out, and that was the end of that, right? Till Wednesday night. And here's another one, okay? I was like, Heidi, how much did we spend on that CAT scan? And I have no idea. But I can tell you this. Thursday morning, when I had another one coming, it didn't matter what it cost. Didn't matter, right? My point is, you need protection, you don't have the military you need, you're going to write the check. I'm just telling you, it's just how it works, right? It's the same concept. I mean, it is life or death. I don't ever want to have, I hope nobody here ever has a kidney stone. I don't know what God made kidney stones for. It's terrible. It's terrible. Okay. But this is a very interesting thing. Now, if it works, imagine the revenue. Imagine the jobs. What if we could pay our military to develop the latest, greatest, coolest, and most amazing, and we could get paid for doing it versus us, paying tax pay. So it's a different monopoly board. We haven't been down this one before. It's a different game. I don't know if it's going to work, but it's different, right? Tax reform. I don't know how much I really think this is going to happen, but this is what's proposed. 3 tax brackets, 10% if you make a little, 25% if you make a medium amount, 35% if you make over whatever they deem to be high income. And no estate tax, no AMT, no Obamacare cost. The only personal deductions you get anymore are going to be mortgage interest and charitable contributions. So everything else just off the table, right? Corporate tax, 15%. Right now it's 35%, and they got a lot of loopholes. But in that, there's this piece they want to make it so we can repatriate the money that's sitting overseas. Apple and Cisco and Microsoft and tons of companies selling goods and services overseas. If they leave the money over there and don't bring it home, they don't have to pay income tax American tax rates. They just sit over there and keep reinvesting it over there. So part of all these bills is, hey, let's bring it home. Let's let all these companies bring it home and give them a one-time reprieve. Bring these hundreds of millions of dollars, or hundreds of billions of dollars if you put it all together, home so they can put it to work in our economy. Well, might work. The problem is we already owe a lot of money, so if we don't collect taxes, that debt issue becomes something that is more challenging. But this is what he's put on the table as the basics for his tax reform package. With a Republican White House and Senate and Congress, I think they're going to get something in this direction done. Don't know what it'll be. It probably won't be this exactly because we can't really afford that exactly, but it'll probably be in that direction. So that tells us that if you have a high income job, or maybe you're paying a lot of taxes because you have a lot of IRA distributions or a lot of capital gains, that maybe if we defer our income into the future a little bit, we might actually bring some of that money through the tax filter in years ahead at a lower rate than we're bringing them through right now. So put all these agenda items together, and I think it gives us a little bit of insight as to why is the stock market at all-time high. What's driving the prices up? Now, at the end of June, the S&P 500 was at 2423. Today, it's right under 2,500, like 2470 something. We're at an all-time high in numerical valuation. Year to date, the U.S. market is up about 11% from the beginning of the year, mostly large growth companies. Small companies aren't up, but maybe 3 or 4%. Now, if companies are investing more in technology, that's creating more profit. If companies are spinning up their capacity to 100%, because they have got to hire more people, right? If airlines are charging full fares and filling up every flight, which they are, those are all healthy in the short term for corporate profits. A big part of what's going on in corporate profits is 60% of the earnings of American companies come from overseas. And overseas, things are getting better. We talked about that on our conference call, for those of you that made that. But if you take a look at all the policy agenda items, it is supporting the notion that these higher price levels are right, that they should be priced at 2,500, which is 17, 18, 19 times annual earnings, which is historically in a normal, slightly high, but not excessively high range. There's a couple other things at work. I heard actual Greenspan was interviewed back in March, and he made the comment that stock prices are beginning to reflect the removal of a long period of political uncertainty. Investors don't like uncertainty. They're okay with good vision, clear, here's my customers, here's some money coming in, who's paying on time, how much are we borrowing. As long as everything is crystal clear, investors are willing to pay more for that investment. Political uncertainty has been a real mess. I mean, think about it. I mean, we didn't know, and you could argue maybe we don't know because the impeachment, whatever, I don't know if that's just the media or if they're going to go somewhere with that. I don't know. I'm not going to get in that political hole. But our political system's ability to get any clear direction accomplished for 5, 6, 7, 8 years has been a real challenge. So Greenspan believes that part of the reason investors are willing to pay 17, 18, 19 times earnings again is because the political uncertainty, the fog is beginning to lift. And we can now see potentially the new rules of the game more clearly. So corporate earnings are going to continue, their expectation to continue to increase because of infrastructure spending, military spending, technology spending. If we can reduce costs, he took a stab at our industry through a nugget at the Department of Labor and FINRA and said, hey, let's clean this up, not make it so crazy, some of the things that they're trying to do. And I don't know if he's going to be able to be successful, but they're looking at it. He changed some things already in the energy industry, removed some caps on some different pieces. There's a lot of industries that he's working to get regulation removed or minimized. Nationalistic policies creates more income. That's another thing. Think about this, okay? This is what I know of you. If we all take our paycheck next week, whether it's a retirement check or whether it's you're doing a part-time job for fun, or maybe you're still working because you're getting paid, but next week you get an extra $300, okay? Most of you in this room are going to take that $300 and you're going to put it in your savings account, your brokerage account, or your IRA. Okay? But if you take the guy that's making $20,000 a year, which is about 80% of our working population, and you give him a $300 paycheck increase next week, what's he going to do with it? He's going to spend every penny of it, right? So if you increase the jobs and the pay at the bottom, you're going to increase a lot of the economic engine. So it's a very interesting set of possibilities. Global economy is really getting better. They've been brutally in a mess for a long time for 1,000 reasons. I could do a whole nother session on that, but it's getting better. It's getting better in a lot of parts of the world for the right reasons. Some maybe not, but a lot of parts of the world it's sustainable. So what's the downside, right? Well, a couple of people are going to get hurt. Savers are going to get hurt. We're going to get inflation. So if you're a saver and you don't take risk, and that's okay, Like, I'm not trying to present to you, hey, go out and take on a bunch of risk. But if you don't take risks so that your capital can grow with inflation, you're going to change your standard of living down the road because you want to be able to keep up, okay? And there's a lot of savers, a lot of seniors, a lot of people living on fixed income. They're going to be hurt if we have inflation. Inflation without productivity gains will actually hurt corporate profits at some point. So only a certain amount of inflation and growth before you actually hurt your ability to grow because you're overheated. Everybody's coming to you on Friday saying, I worked 80 hours this week. I can't work. I can't lift my head up. I'm sick and tired of this job. I'm going to quit if you ask me one more hour of work, right? That's not a healthy environment either. And then deficit spending can cause structural problems. At this moment in time, if we took all the accumulated deficits, everything we have in the U.S., it's about 80% of what our economy produces in its entirety in a year. So if we took every single paycheck, widget, mousetrap, anything you can come up with that we can produce as an economy this year, and we gave it all away, 80% of it, we could get rid of the deficit. But the reality is, if it gets over about 100%, it gets to a point where it's almost what they consider point of no return. We've seen problems with nations that have that happen. So if we have an increased federal deficit, right now 75%, 1 year's GDP, it's actually between 75 and 80 depending on whose measurement you look at. We have some concerns about what does that look like if we keep financing. If we finance a brand new infrastructure, we might have some problems 10 years from now. Like the whole, the debtor is the slave to the lender problem. You know what I mean? I just don't know who the lender's going to be, right? The Trump outlook. In the past, very shaky before the election, right? So now people say, well, now we can see. We have some roadmap. Other people say, nope, this is going to be good, right? Other people say, no, we don't know what's going on, okay? This is the camp I'm in. I have no idea, but to me, it's truly interesting because there are areas about the way it's being done we haven't seen before, and it might work. But if it does work, there'll be consequences, and I don't know what they'll be. So I just wanted to share that with you. I know that's, you're not going to go home and say, wow, I learned something, but having perspective is a big part of making good decisions. So I wanted to share that part with you. From an investment standpoint, here's our thought. So if the policies work to produce a robust economy, we're going to want to own stocks, right? If it creates economic instability or political problems, turmoil, spiraling debt, we probably don't want to own stocks. But we don't know what's going to do. You want to diversify. Now, I know you can't read that. I'm standing right here and I can't read it, all right? But let me tell you what it is. This is each one of these is a year, and each color is a different investment category, right? So yellow is emerging market stocks, and I don't know, gray is bank loans, right? This green thing here is U.S. S&P 500. So what happens is each year you got a range of returns for different assets, and in some years the U.S. stock market is weaker than a lot of other things. Like in 2002 is the worst of all of these things. However, in 2013, 14, 15, and 16, interestingly enough, it was almost the best of everything, right? Now, one of the things that we have had a very difficult time with clients and just doing webinars and seminars and talking to people about investing is that there is a recency bias. We all tend to think that what just happened is going to happen again tomorrow. And the problem with recency bias is that this piece right here is very expensive relative to all these other things that have been a lot less productive in the last 4 or 5 years. But we all want the returns of what just did well. So naturally, we want to own, the S&P 500 right now because it's done pretty well. Our view is you need to diversify because it's only a matter of time. I mean, look, here it was near the bottom, it was in the middle, it was in the middle, it was in the middle, now it's near the top. Over the long run, everything ebbs and flows, and you need to diversify, right? And we've been hurt. It's called, the guy on TV says, it's death by diversification. Like literally, we had a lot of this stuff, and we still do, and so we underperformed people that just had that in these 4 years. It's or diversification, I've heard it called, right? But the reality is, we don't know. And if Trump or any of this stuff in the US becomes unsustainable, this is going to be down here and everything else will be slightly better. Does that make sense? So we need to diversify because we don't know. We're in an uncertain time. We've got a new game. It's Trumponomics. This isn't Monopoly anymore, right? It's a different deal. So diversification helps you. Like if you take all these different classes over time and you merge them all together, then you would have this red line. It's much more consistent than saying, I'm going to pick this one, but you might have picked that one, right? Now, for those of you that know us, we have another piece of this, and that is that it almost works all the time. There are times when it does not work. Everything can be correlated in a downside if you have a world credit market collapse, which is what we had in 2007 and 8. Everything that's connected through currency and credit, it all is connected together, right? And you can only diversify so many places that doesn't ultimately have to go to the bank to get the paycheck or to get money to buy the next product. So because of that, we still feel like this is an important reason to use the hedging strategy. Our defined risk strategy, I know we've said it 1,000 times, but I can't say it enough in this environment. Every piece that you have in stocks, take the 200-day moving average, we put a floor, we put a sell at the 200-day moving average. If it drops below it, we're out, right? That way, when it gets worse, it accelerates down, we can sit there, hey, we're okay. We're sitting over here letting the world deal with that, and eventually it'll settle down, and we'll re-enter when the 200-day moving average and the price reconnect. That strategy has helped us keep your portfolios from being a roller coaster in the last 2 years. Been very, very consistent. Now, we haven't been out. We haven't been risk off since a year ago. So it's been a while now because things have been plodding along. But if we do see a pullback, market drops back to where it was the last 6 months, we'd pop out and slide over in short-term bonds or cash. We'd sit tight, let the market do what it's going to do till it finds a new bottom and then resettles, and we would resume our journey. But that's a way to protect you what the diversification cannot. So in a world where we don't know if Trumponomics is going to be a great thing or a terrible thing, it's a good way to do it, kind of hedging your bets. Conclusions. I think it's really going to be interesting. If we pay low-paid and middle-wage earners 20% more money, do you think they'll come back to work? I think they will. I think they are. But if we create, this story about the Toyota plant, I don't know if you have heard of it. So Toyota was going to go in Mexico and set up this facility. They were going to make the Corolla. They were going to be able to get it there, have it total production, shipped here, ready for sale at the wholesale level, $14,500. They're going to retail it at $24,000, right? Trump said it's not going to happen. Literally first week he was in office, it's not going to happen. He said, you go down there, that's fine. We're going to tax each one of those cars $6,000 to bring them in. Toyota said, let me rethink that. So they said, all right, well, that doesn't make sense. We better play ball because this guy's got some influence. So they nixed it. They're going to set it up in Des Moines or somewhere, in a area they can do it here. It's going to cost $6,000 more. And they're going to sell them for a little bit more. Few less people be able to buy them if they got to pay $30,000 for them versus $24,000. But they're going to put 30,000 people to work. Well, that's not all the story. What happens to the fact that the 30,000 people that they need to work in that plant, they already got jobs. They're already working down the street. They're going to have to pay them to come over here and work. They're going to create a vicious cycle. And he's doing that in all these industry groups. You raise the income level at the bottom and you push it up manually by forcing jobs, forcing nationalism. It's going to look different. It's going to look different. Might be great, might be not so great. I don't know. But we need to own inflation assets if it does. Earnings going up in manufacturing, cyclicals, materials, technology, all these things are responding positively because of these agenda items. Cost of goods likely to rise. We know that. You probably wouldn't be sitting here if you didn't know that. A lot of people don't know that, right? And then we just got to have a risk management process. So, and not all of you have everything with us. So whatever you've got anywhere, you think about what would be my trigger that if it began to be a problem, what would I do about it, right? You got to have some process in mind. It can't be like, well, and I feel like it's getting ready to go down, I'm going to sell it. That doesn't work. Because then you got to feel like it's getting ready to go back up. that doesn't work either. But these are the things we think are on the horizon.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.